Hello everyone. As promised yesterday, I spoke about gold miner, about CENTAMIN, and they are the only gold mining company that makes sense for me because I like companies, any company, doesn't matter. I like them to have really high cash flow, and so far I have only find one mining company that has really high cash flow, one gold mining company, because I have found some iron ore mining companies that are also really profitable. They have really high profit, net income, and free cash flow, and this is what I primarily like at a company. So moving on, this is CENTAMIN. This is their website. This is not sponsored or anything. I just I have a few shares in this company because they make sense for me, and I want to show you why they make sense for me. So this is their site. They're listing on the London Stock Exchange, on the probably Toronto Stock Exchange. You can also buy them from US, whatever. You can buy them basically. It's fine. If you want to learn more about them, just go to their site, basically. So, how do you value a company? Well, first of all, you need to check the market cap. This is 928 million British pounds, most likely. They have a really good PE. It's 11. Uh, they have a really nice dividend, which, if I'm not mistaken, they can easily afford. So first multiple that you need to look at is the P ratio, and it's 11, which is very nice. The problem with the PE is that it's based on net income, and that could be manipulated through accounting rules. So you also need to check the free cash flow because that's a more cleaner. It's a cleaner version of a company's profits. And if you're wondering what you're doing with your free cash flow, well, there's a few things you can do. You can obviously you can pay your dividends, so uh, you have to be careful with companies because they have to have a high enough cash flow to sustain that dividend. So you can pay dividend, you can pay your debt, you can make acquisitions, um, and there's like two. Well, you can buy back your stocks, or you can reinvest. Obviously, you can reinvest the money. So these are the five main things a company can do. There's probably more, but these are the most important one. So what you can do, you can go, let's change the screen a bit to zoom in a little. You can go to a company's financial statements, and what you're looking for is for increasing revenue, which is not really increasing from 2020 to 2021, but going back further, it looks all right. Uh, Net income, again, I'm not really that interested in it, in net income, because it can be manipulated. Um, but it looks all right. You want them to have really low debt. Again, compared with net income or free cash flow, which they do, they have almost no debt. And most importantly, you want to go to their cash flow statement. And as you can see, they have positive cash flow. It was decreasing lately, but usually you need to make the average. This is what I learned from other people. Of course, you need to be conservative and look at the average over the last 5 years. Because, for example, you can have a company that has increasing cash flow every single year, and still, to be conservative, gonna have the average. Don't look at just the last year, because it might be a fluke. It might be a fluke on the upside or on the downside. So the yeah, this is you can use Yahoo Finance for this. This data is free, but it doesn't go back too much. Like, you have about 4 years of data. I am getting a lot of my data from some guys on YouTube that I really like how they how do I say it? How they are analyzing stocks, basically their view on stocks, and they basically teach you to find value. They made a really nice site. This is their channel. If you can click it, you can go to their channel. But yeah, they have this site. They get basically the same data. Yeah, you can see there's a price difference because this is in British pence or pennies, whatever, and this is in Canadian dollars because it's on a, yeah, it also says here. So you can also check. They have extensive data, but of course, I forgot to say, you have to be a Patreon member, or you can make an account on their site. It's not free, but I did it. It's like $1 a day right now. I got it for like 30 cents a day, about 18 months ago, because I was one of the first ones to pay for their service. Actually, the site wasn't even out. They were just saying it's coming, and it did. They made a really nice site with data, and yeah, they have 8 pillars that you need to look for at a company. They are looking at the average PE ratio over the last 5 years to be lower than 22.5. I find this really high. I usually want it to be below 15 to really feel like I'm getting a good deal. 5-year return on invested capital to be higher than 9%. This is something probably Warren Buffett mentioned, that good companies have obviously you want a good return on your investments, right? You want revenue growth. You also want net income growth, but again, it's not that important. You also want your company to not dilute you so much. So they should not be issuing shares like crazy, because you are getting diluted, and it's not good. It's really bad. And you want the long-term liabilities to be lower than the 5-year free cash flow average, if that makes sense. Basically, you want low debt, right? You want to be able to pay down your debt. And you also want free cash flow growth, which they don't have, but I think it's fine, because I believe the last year was probably a fluke, and they'll recover. Again, they are the best mining company that I have found so far, when it comes to free cash flow, of course. I don't know every single company. I just found this one and I like it. Now, one of the problems that I see with this last year of lower free cash flow is they don't really afford to pay down the dividend, but they probably have a lot of cash on hand. I'm not sure where to check it, but yeah, beginning cash. Yeah, they have to supplement like 20 million dollars, Canadian dollars, to pay down the dividend. So I think they're fine. Yeah, we'll see the 2022 year report. Right, so this company looks really, really good overall. Oh, and by the way, you want the the market cap of the company to the multiple. Basically, you divide the market cap to the 5-year average and you get a multiple, and you want this multiple to be again lower than 22.5. For every single stock that I buy, I want it to be lower than 15 usually, if you're only looking at these 8 pillars. What's really nice on their site, they also have a stock analyzer, and it's kind of iffy on foreign stocks, foreign to the US stocks, but it looks to be working fine. So you can actually make some assumptions, and they have a calculator and you can hit analyze, and we're gonna do that right now. Let's be conservative, assume 3, 4, 5 revenue growth, profit margin. Let's go 14, 16, 18. Free cash flow margin usually should be about the same, but yeah, I'll do just 1% higher on the free cash flow. PE, again, I want a good deal. 13, 15, 10, 12, 15. And this here you complete with your desired annual return. Now, one issue that I have with these guys is they're claiming that you're getting like 10% annual return on the S&P 500 or something like that, and I don't really agree with that, because since 1982 the S&P 500 yielded like somewhere like 8% year over year, and if you go further back in time, it's getting lower and lower. So it's not really 10% per year. But if you're ignorant, if you don't want to buy individual stocks, it's okay to buy indexes, but only if they are fairly valued or undervalued. Like I would not buy the stock market. Actually, right now it looks okay, because we had like a 20% retracement, so it looks okay, but I would not really buy at the top. Try to find value, in my opinion. Right, so you hit analyze and you're getting a price. So you're basically below every single price. So basically what this means is that if you believe the assumptions from the middle column, and if you buy at $1.50, 50 cents per share, you should have an annual return of 12.5 over 10 years, you know. So yeah, I really like this mining company. I hope they're gonna keep doing a good job in the future, but yeah, if you wanna, and I do recommend you go on their site and read a lot more, see what plans they have for the future, if they're exploring new mines, yeah, and make a decision for yourself. I do have a few shares. Again, I'm not a rich guy. I'm like middle class, something like that. If I would be in the United States with my salary, it's almost the minimum wage. But where I live, I'm middle class. So again, everyone can invest. Just do your homework, basically. Do your homework. Also, if you want to see a chart of CENTAMIN, it doesn't look great. This is a weekly time frame, so every bar is 1 week. I'm I mean, in my opinion, it looks really good because I believe it's undervalued. So you should only buy a stock when it's undervalued. Yeah, I like them. I like them because they seem to be having pretty solid cash flow, and this dividend is really nice. I mean, 7%, it's awesome. Not that awesome in this inflationary environment, but what the S&P 500 gives you, what, 1.5%? It's a joke, right? So if you're looking for a mining stock, I think this is the best one that I have found so far. Let's do a comparison. For example, let's look at some other mining stocks that I had in the past. And I did do a profit because I bought them in the bottom of the market in 2020, right? In March. But their financials look horrendous, man. Look at the free cash flow. Look, they are losing. They are losing cash flow. Okay, I don't understand exactly. Obviously, I don't understand how the entire company works, how they make a profit. But look at these guys. They lost 400 million in the last year. It's probably they're not selling their gold. I don't know, but yeah. For example, for IM Gold Corporation, they look like they made a lot of investment this year. I mean, it's double than it usually is. And I probably bought them in 2020 because I was under the impression that they're gonna keep positive free cash flow moving forward, but they didn't. Maybe they obviously they probably know something that I don't. But by the looks of it, they made a lot of investments. I'm not completely sure. I didn't check. You also always get more details on their reports if you want more information. This is just financial numbers, so usually you shouldn't buy just based on that. For example, Kinross, they seem to be having pretty positive cash flow overall, but the market cap is pretty high. I mean, let's say this year and this year was a fluke. Let's say the average is like 200 million and the market cap is 5 billion. That's a 25 multiple. It's pretty high. And look, I mean, the PE ratio is 22. I don't really like them. Let's see what KGC was it? Yes. Yeah, they look a bit expensive on the cash flow side. They're not issuing too many shares, which is fine. But they oh my god, they have quite a lot of debt compared to the free cash flow, so I don't like them at all. Yeah. Anyway, let's not get into details with too many other companies. This was my brief analysis and explaining why I like CENTAMIN. So this is CENTAMIN analysis. I hope you enjoyed. Oh look, clicking buttons. This is their all-in sustaining costs. So basically, for every ounce of gold that they mine or sell, not sure which one, but let's say for every ounce of gold that they sell, they their costs are $1,200. So basically they should make right now, $600 per ounce, something like that. So if they mined 415,000 ounces in 2021,